And there you have it. The markets are officially closed on this Friday, August 23rd. Hello, investors and traders. I'm AJ Monte, and this is the weekly market report. We had a lot of action today as Jerome Powell came out talking about how inflation is more or less under control and that they see room for future rate cuts. I'll get to that in a moment. As you can see here from the daily candle chart of the diamonds, we have a nice green candle right there, but it is right at a high resistance point. I believe we're going to start pulling back after a short little rally on Monday, possibly Tuesday, but I'm keeping this target down below where that gap is still open. Now, if you're following my weekly market report, you'll know that over the past couple of weeks, I officially called a top. And I keep saying this over and over again because I have to for the record, because there's still some folks that misinterpret the difference between a topping pattern and a high. I did not call a high, called the topping pattern. And as you can see here, we are at the point where we're testing this resistance for the third time. If we pull back from that, like I think we will towards the end of next week, we could very well have what's called a triple top. So again, to reiterate what I just said, I think we could go a little bit higher Monday and Tuesday, and then I'm keeping that downside target right down there at $400.52. I'll adjust this later on to match that low. If we go on to IWM, you'll see it's going to be the same story. We have a good green candle on higher volume, but the oscillators are still overbought. Again, I think we'll go a little bit higher on Monday as the momentum continues on the heels of the Fed announcement today, and then we're going lower. This is going to take a little time, but I think we're going to get right back down to that target at 206.47. Again, we have a lot of resistance up here, right around the 227 area for IWM. And again, the oscillators are still overbought. If we get any kind of a drop in volume on Monday or Tuesday, we could see that pivot forming a little bit earlier than I expect. So that is IWM. Looking at the Qs, pretty much going to be the same story where I think Monday and Tuesday will go up. This is a bullish harami right here after it followed a bearish engulfing. So these two are conflicting. Again, I still think we'll go a little bit higher and then we'll come right back down to fill this gap down here at 461.69. You can see that even though the Qs were up today about 1%, the stochastic is still heading lower and about to cross with a sell signal. And we've already crossed with the sell signal on the CCI down below. So keep your eyes out. If you're long anything, the name of the game right now is to protect profits and certainly make sure you're managing risk if you're taking any new long positions at this particular point in time. All right, SPY, we've got another bullish harami right there after a bearish engulfing yesterday. Again, I think we're going to go up, test that high, and then come down. Again, the longer term downside target is 543.88. Look at the oscillators, still overbought and showing negative divergences here, especially in the CCI. These open gaps below the market are going to most likely act as price magnets. You can see that the gap back here, once that's filled, will be a resistance point because 80% of the time gaps do fill. And then what happens after they fill? Well, if you're following along with my gap fill rules, you know that 80% of the time after gaps fill, prices tend to reverse. So we're keeping an eye on that. If you take a look at the VIX, you can see here that we have a pivot lower on a red candle. I think we could go a little bit lower on the VIX, but you got a lot of support down here on the VIX, right around the 15.5 level. I'm keeping that upside target on the VIX at 23.89. If you were looking at my chart of the week from the week before last, I posted that on X. I have an upside target on CVX at 148.21. Today we got up to 148.09. I think that target will hit. We also have a new relationship with ZeroHedge. Keep your eye on that. I'll make an announcement towards the end, We are now putting our chart of the week out through ZeroHedge. I'll give you the link in the description box so you can follow along. We're going to try to get the chart of the week out on Sunday evening, possibly Monday morning, so keep your eyes open for the chart of the week. If you're following me on X, be sure to note my silver forecast, my Bitcoin forecast, and also I'll be posting the chart of the week on ZeroHedge on X as well, so you can follow. There'll be plenty of opportunities for you to get through to me. You can make comments on the article that I put out through ZeroHedge. You can make comments on this YouTube channel. You can make comments wherever you want on my Facebook or X, although I do focus most of my attention on addressing comments and questions on YouTube. So if you have a question about the markets or a particular strategy, go ahead and put it in on YouTube under the comments field, and I'll be sure to get back with you on that. Well, here we go. Most Americans believe that the economy is already in a recession. In fact, 39% of Americans say they've skipped meals to make housing payments. That's pretty incredible when you think about it, because if you're listening to the Fed today, it sounds as though everything is looking pretty rosy. In fact, they believe that they have inflation in check. Well, if you take another look at some of the data, you're going to see that we have a 219% increase year over year in commercial foreclosures. Does that sound like we're doing great with the economy? It doesn't sound like we're doing great to me. Taking a look at U.S. new bankruptcy filings, 6,276 in the second quarter of 2024. This is the highest level since Q2 of 2017. So at Sticky Trades, we're looking at real data and not the manipulated data that we're seeing, especially what we saw with the jobs report. We're looking at the data that's giving us a very clear and honest picture of what's really happening in the economy. In fact, if you look at what the University of Michigan put out with regard to consumers expecting a change in income, consumers are expecting a drop in their income over the next year. It's not looking positive. If consumers are expecting a drop in their own income, they're probably going to cut back on spending. So that contributes more to the idea of a recession on its way, or possibly we're already in a recession. Another bit of data coming from Game of Trades, credit card defaults are now rising faster than what we saw in the 2008 financial crisis. So credit card defaults are now at record levels. Again, pay very close attention to that. And if you look at what's happening in the real estate market, about 59,000 home purchase agreements were canceled in July alone, which equals 15.8% of the homes that went under contract that month. That's the highest percentage of any July on record. Folks, please pay attention, because if you're buying into this hype that everything is going great and the Fed is expected to cut rates 4 times by the end of this year, then think again, folks. We've heard that story before. In fact, at the beginning of the year, investors were expecting 7 rate cuts. We still haven't had that yet. The Bureau of Labor Statistics finally admits that they've been lying about the jobs numbers. So if we can't trust the BLS with putting out job numbers, how can we trust any numbers? Folks, it might sound like I'm trying to rain on this parade for the bulls, but I'm not. I'm trying to bring the reality of what's happening here in the market so you don't get trapped. Listen, we've been trading on the long side for most of our trades throughout the year, and we've been doing very well. But my long-term outlook is still going to be drastic, and I still believe we're going to see the March 2020 lows eventually when we get into this major bear market that I think is right around the corner. This is what the jobs revision looked like. This is a shocker. It's the second worst revision in U.S. history. So when I talk about the data being manipulated, this is the evidence of what I've been talking about for years. In fact, earlier this week, I put out a report on a webinar through our members that the jobs numbers would be revised. I did not think it would be revised to that level, but I did talk about the revisions and how 13 out of the last 15 revisions have been lower. And so this is the manipulation I've been talking about, and it seems that the talking heads on a lot of these financial programs are just not bringing up the obvious. Now, today, with Jerome Powell talking about inflation and how there's ample room to move on rates, you have to see that investors are betting that the Federal Reserve will cut interest rates by 50 basis points at least one of these cuts. Does that sound familiar? Well, Powell noted that the timing and the pace of the cuts will depend on incoming data. Well, what data is he talking about? If we're getting data like we just saw with the job reports, what kind of data is he relying on? I'm not going to hold my breath on this one, folks. I know that a lot of you who are long are continue to buy more at the highs. I'm just extremely cautious, and I'm waving that caution flag to all of our members to make sure that they're putting protective stops in place and making sure they're protecting their downside. Like I said, we're putting out the chart of the week through ZeroHedge. You will be able to find this under the contributors tab, and I'll make mention of that on my midweek report. I'll put it out on X. I'll put it out on Facebook. Keep your eye on the downside and focus on managing risk. Thank you so much for liking, sharing, subscribing, and especially commenting. We have a lot of participation in the comments field there, and I thank you for that. I'll do my very best to keep up with the questions and comments. So stay tuned, and I'll talk to you on the next video. So long.